Okay, so we'll walk through some of Chapter 7 exercises here. So the first one, they give us 10 different transactions, and then basically we're doing our journal entries and our T accounts. So this, excuse me, is good practice of our journal entries. So let me see if I can scoochie this over so we can see it a little better. Okay, there we go. Okay, so our first one, we purchase materials. So we're going to debit materials inventory. It tells us it's on account. So then we're going to credit accounts payable. Then we issue $14,500 of direct materials to the production department. So it's going to come out of our materials inventory and then go into work in process. And again, it's related to direct materials. Then we purchased another $11,000 for materials on account. So again, that goes into our materials inventory. And then we credit accounts payable again because it's on account. Then we issue $900 of supplies from the materials inventory. Well, supplies are going to be overhead. So those will debit manufacturing overhead control. And again, though, we'll credit the materials inventory because we're taking it out of our inventory. Okay, then we paid for the materials in transaction 1. So then we're going to debit our accounts payable and then credit cash for the $13,000 that we paid for. Okay, then we paid up here $19,200 cash for utilities, power, equipment, and other miscellaneous items for the manufacturing plant. So all of those are going to be overhead. So then they go into our manufacturing overhead control as a debit, and then we credit cash. Okay, then we incurred direct labor costs of $22,000, and we credited wages payable. So if they're direct labor costs, they're going to go into our work in process dash direct labor to identify their direct labor. And then we set up the liability, wages payable, to our employees. Then H or 8, we issued $1,300 of supplies from the materials inventory. So again, that is going to go into our manufacturing overhead control because they're indirect supplies, and then we credit the merchandise inventory. Then we apply overhead on a basis of 85% of our $22,000 of direct labor costs. So then we calculate that out, and it ends up being $18,700. That goes into our work in process dash as overhead, and then it credits the applied manufacturing overhead. So actual costs go to manufacturing overhead control. When we charge it out to the jobs based on our predetermined overhead rate, it goes to applied manufacturing overhead. Then number 10, we recognize depreciation of $11,600 on manufacturing property, plant, and equipment. So that goes to manufacturing overhead control, and then we credit accumulated depreciation, property, plant, and equipment. Okay, then B, then they have you trace those through the T accounts. So again, you got to reference what journal entry it is, put in your debits as we purchase that materials, your credits as we issue those out into work in process. Your labor comes in from your wages payable. Then we pay those accounts payable. So this is also good practice of kind of tracing all those journal entries into T accounts so you can calculate that ending balance. Okay, then we're going to assign costs to jobs. So they give us some information here in the T account along with some additional information. And then they ask us a few questions down below. So what cost is the amount of the direct materials issued into production? So this one we can just look at the T account. What we credited our materials inventory for is the materials that are going to be entered into production during June. So that's $144,000. Then B says how much manufacturing overhead was applied to the products. So those we don't, if we look up here at our T account, we don't see a number in there that we can pull. So then we have to look at the detail. Manufacturing overhead is applied at 90% of our direct labor cost. And our direct labor cost is, we can calculate it. So we're going to take the 3,900 hours. Let's go down here. The 3,900 hours that they give us times the $25 per hour. So that's 97,500 is our direct labor cost. And we're going to multiply that by 90%. Then requirement C, the cost of the units produced. So again, this is one you always want to check at the T accounts first because those are easiest. The cost of our units produced is what would have been added into finished inventory at the end of that production period, so the 262,000. Then requirement D, what is our balance in our work in process inventory? So all we have here is the beginning inventory. So if we go down, we will see that we need our beginning inventory plus transfers in. So the 144,000 is what was coming out of our materials inventory. So it would have went into work in process. Our manufacturing overhead is what we calculated in B, and that was the 87,750. So that would have been added in. And then our labor is what we just calculated in C, correct or no? No, I guess we did that as part of B as well, the 97,500. So our materials plus our labor plus our overhead and plus our beginning balance, then that gives us what would have been totally in our work in process for that period, or what was completely started. Then what did we transfer into finished goods? We transferred in 262,000. So then that's what we subtract out to get to our ending balance. Then E, what is our over or under applied overhead? So we know that our total, our actual, is 112,000, and then we know that we applied what was in B. So B is 87,750. So the difference between those, our actuals were 112,000, our applied was 87,750. So we're under applied by the difference. And then finally, what is our operating profit? So again, remember that under applied is going to get written off to cost of goods sold. So we have sales, which is given to us here. So during the month, there's $351,000 of sales. And then we calculated out that cost of goods sold, the 181,250. Oh, no, we didn't calculate it out, but the 156,000 plus that under applied. That is our cost of goods sold. And then we have our administrative costs and then I guess this is how we know the 157,000. If it came out of our finished goods inventory, it would go into our cost of goods sold. So then that 157,000 plus that under applied overhead is what went to cost of goods sold. All right, then our selling and administrative costs were also given to us, 67,000. So we subtract those out, and that leaves us with an operating profit of 102,750. Okay. All right, then we have this machining. They have manufacturing overhead estimated to be $279,000. We've got direct materials of $450,000. We've got these 3 jobs, and they give us the actual direct materials for each one of those jobs. And then they give us the actual manufacturing overhead and the total direct material costs. Manufacturing overhead is applied on the basis of direct materials using predetermined rates. So if we come down, we've got the application rate of the $279,000 divided by $450,000. So the $279,000 is the overhead divided by the direct material costs, and that gives us a rate of 62%, 0.62. So then we're going to take the direct materials for each one of those jobs. So $15,000 for job AM002, $55,000 for job AM005, and then $70,000 for job AM008. So we'll take each one of those, multiply by the 62% to get to the cost that we're going to allocate from an overhead standpoint. And then what was the over or under applied manufacturing overhead? So we add them up, all 3 jobs, what did we allocate in total? And then we compare that to the actual, which it tells us the actual manufacturing was $313,000. So, So those are not just added up though. So this is the total of 3 jobs, not all of their jobs. So their total would have been the $540,000 of direct materials times the 62%. Compare that to the over and under applied. So they have more than just those 3 jobs. And again, in this case, the applied was more than the actual, so it makes it over applied instead of under applied, like the last one. Okay, then we can prorate that. So we said a lot of times people just charge it off to cost of goods sold, but if they chose to say, okay, I want to prorate this over or under applied to my work in process, my finished goods inventory, and to my cost of goods sold, and they have actual manufacturing costs of $313,000, and then the manufacturing overhead is applied on the basis of direct material costs using the predetermined rates. So again, we're going to come down here and they're going to calculate out a percentage. So here is the overhead divided by the direct materials to get to that percentage. Then we're going to look at the total direct material. Here. So the total direct material cost is $540,000 times the 62% gives us the $334,800. Compare that to the $313,000, and we get that over applied amount. So then now that over applied amount, we're going to allocate it to these 3 accounts based on their proportionate percentages. So if we add them together here down below, so our work in process, finished goods, cost of goods sold, and then we take each line item and divide it by the total. So our work in process is 6%, our finished goods are 19%, our cost of goods sold are 75%. So we use those percentages to allocate out that under applied overhead. And then we would credit our work in process, credit our finished goods, and then credit our cost of goods sold. Okay, then another allocating to various jobs. So we've got manufacturing overhead of $1,725,000. direct labor of 750,000. We worked 4 jobs, and they give us the actual direct labor for each one of those jobs. Our actual manufacturing overhead ends up being 1,710,000, and then the actual direct labor costs were 735,000. And again, it's applied based on that direct labor cost. So we'll come down here and look at our rate. So then our total overhead divided by our total labor, it's 2.3, or 230% of those labor costs. So then we list out the labor costs for each one of the jobs, multiply those by 2.3, and then these would be the overhead that we would allocate to each one of those jobs. Then we'll look at the over or under. Again, it's going to be more than that total. So we've got our total applied is going to be the 735,000 total of direct labor costs, actual labor costs for the year with 735,000 times the 2.3, or 230%. Compare that to the actual that we actually incurred, which is the 1,710,000, and then that gives us an under applied of the difference, which is 19,500.